Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial mysteries that shape our world. Today we're diving deep into Lowe's latest financial report, and let me tell you, it is a story of big moves and shifting landscapes. Get ready to see how a retail giant navigates acquisitions, market shifts, and its own strategic plays. First off, let's look at the top line sales. For the 3 months that ended on the 31st of October 2025, Lowe's brought in a massive $20.8 billion. That is up from $20.2 billion in the same period last year. Now, if we look at the longer 9-month period, sales were $65.7 billion. A slight tick up from $65.1 billion in the previous year. Digging a bit deeper, the gross margin, which is what is left after you take out the cost of the goods sold, was 34.19% of sales for the quarter. That is a little better than the 33.69% last year. Over the 9 months, it was 33.80%, also an improvement from 33.45%. This improvement is good news, suggesting they are managing their costs better or maybe benefiting from less intense competition. Now, let's talk about expenses. Selling, general and administrative costs, or SG&A, took up 19.99% of sales in the quarter. This is a noticeable jump from 18.97% last year. For the 9-month period, it was 18.85% compared to 18.22%. This increase in SG&A is significant. Part of it is due to the costs of acquiring 2 big companies, Artisan Design Group and Foundation Building Materials, and also rising employee costs. While sales are up slightly, these higher operating expenses are eating into profits. This brings us to operating income, which represents profit from the core business operations. For the quarter, it was $2.48 billion, a slight decrease from $2.54 billion last year. As a percentage of sales, operating income dropped from 12.57% to 11.92%. This confirms that the rising expenses are having an impact. And the bottom line net earnings for the quarter, it was $1.616 billion, down from $1.695 billion a year ago. Diluted earnings per share also saw a dip to $2.88 from $2.99. This is a clear signal that despite higher sales, profitability took a hit. Lowe's does provide an adjusted earnings per share figure to help us see past some of these one-time events. For the third quarter of 2025, adjusted diluted earnings per share were $3.06. This is higher than the reported $2.88. And it helps put the previous year's adjusted figure of $2.89 in perspective. It essentially tells us that excluding acquisition costs and other special items, the underlying business performed better than the reported net earnings suggest. Now, a huge part of this report is the acquisitions. Lowe's bought Artisan Design Group for $1.3 billion in June and Foundation Building Materials for a whopping $8.8 billion in October. These are massive moves designed to bolster their offerings, particularly for their professional customers, and expand their reach in the home building and renovation market. These acquisitions are reflected in the balance sheet with significant increases in intangible assets and goodwill. For instance, the FBM acquisition alone added over $5 billion in intangible assets and nearly $3.3 billion in goodwill. That is a substantial chunk of value being added to the company's books. Speaking of intangible assets, you can see a dramatic jump from $281 million at the end of November 2024 to nearly $6 billion by October 2025. This is directly driven by these acquisitions. Goodwill also shot up from $311 million to almost $4 billion in the same period. These numbers highlight the scale of the integration Lowe's is undertaking. Let's look at cash flow for the 9-month period. Cash from operations was $8.3 billion, a slight decrease from nearly $8.7 billion last year. The company mentions this decrease is partly due to the timing of tax payments, which were deferred due to hurricane relief. The investing activities section tells a dramatic story. For the 9 months in 2025, they used nearly $11.7 billion, a massive leap from $1.3 billion in the prior year. The majority of this, over $10 billion, went into acquiring businesses, primarily Foundation Building Materials. Their capital expenditures, which are investments in things like stores and technology, were also up at $1.6 billion compared to $1.4 billion. In the financing section, we see how they paid for all this. The company issued $7 billion in new debt in the 9 months ending October 2025, starkly different from not issuing any debt in the comparable period last year. They also repaid some debt, but the net effect is a significant increase in their borrowing. This increased borrowing shows up on the balance sheet. Total liabilities for Lowe's jumped from over $58 billion at the end of November 2024 to over $63 billion by October 2025. This rise is fueled by new debt taken on, particularly for the FBM acquisition. and also increases in operating lease liabilities. Interestingly, the shareholders' equity section shows a deficit. This means the company's liabilities are greater than its assets, resulting in a negative number for shareholders' equity, which is expressed as a deficit. This is not uncommon for large corporations with significant debt and share repurchase programs. The deficit widened from negative $13.4 billion to negative $10.4 billion, which might seem like an improvement, but it is important to look at the details. A large part of this is their aggressive share repurchase program. Speaking of share repurchases, the report indicates that in fiscal 2025, Lowe's paused its share repurchase program. However, over the 9 months of 2024, they spent a significant $2.5 billion buying back their own stock. This action reduces the number of shares outstanding, which can boost earnings per share. But it also means less cash is available for other strategic investments or to reduce debt. The remaining authorization for share repurchases is still a hefty $10.8 billion. In terms of physical footprint, Lowe's had 1,756 stores open at the end of October 2025, up slightly from 1,747 a year prior. This indicates a strategy of modest expansion and consolidation rather than aggressive store growth. A notable piece of information is a legal settlement disclosed. Lowe's agreed to pay a $12.5 million civil penalty to resolve issues related to LEAD, safe practices under the Toxic Substances Control Act. While this is a significant amount in the context of Lowe's overall financial picture, it is not a material disruption but highlights the ongoing compliance challenges in the industry. Looking ahead, their risk factors remain largely the same as previously disclosed. They are still concerned about broad economic conditions like inflation and interest rates, consumer spending, and potential supply chain disruptions. The integration of these large acquisitions presents its own set of risks and opportunities. So what is the big picture here? Lowe's is clearly in a transformative phase. The acquisitions of Artisan Design Group and Foundation Building Materials are bold bets aimed at capturing more of the remodeling and home building market, especially for their professional clients. This is a strategic shift to become a more comprehensive solution provider. However, these moves come with significant costs, as seen in the jump in SG&A expenses and a large increase in debt. While sales are showing modest growth and adjusted earnings look better, the reported net earnings and the widening liabilities show the immediate impact of these major transactions. The company is essentially going all in on expanding its pro-business and its offerings, which could pay off handsomely if the integrations are successful and the market for home improvement continues to recover. The challenge will be managing the debt load and ensuring these new businesses deliver the promised synergies without overwhelming the core operations. It is a high-stakes game of growth and integration. Alright, that is our breakdown of Lowe's latest financial report. What is your take on these acquisitions and the company's strategy going forward? Do you think they are making the right moves to dominate the market? Drop your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps us out, and make sure you subscribe for more corporate breakdowns. And hey, if you want to chat more about these reports and connect with other finance enthusiasts, join our Discord community. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.